Hi, this is Antoine Harris with Platinum Bridge Wealth Strategies, and I wanted to talk a little bit about inflation. We've seen a number of headlines that have really indicated that inflation is starting to take hold a little sooner than we had anticipated. So I wanted to talk about the implications for portfolios here domestically and around the world. So what's causing this inflation? Of course, the first reason is really unprecedented federal stimulus. Never in the history of the world have we seen this amount of money flow into the economies domestically and around the world. We actually have no idea what the ultimate impact is going to be of this amount of money chasing so few goods and services. So typically, theoretically, we would think this would be inflationary, but we really don't know. This is coupled with artificially low interest rates, support from the Federal Reserve in the open market buying assets to keep rates artificially low. This is all supporting an unprecedented level of demand. Also, many companies had really pulled back on production due to an anticipated muted demand throughout 2021. Well, that's caused some supply chain disruptions, but due to the vaccine coming out a little sooner than many companies had anticipated, everyone's come back into this marketplace all at once. That extra demand, along with those supply chain disruptions, have caused prices to increase. Now, there are many reasons that we think this inflation is transitory. So one of the main mitigating factors in opposition to runaway inflation is the continued advancements in technology. So as we become more productive through technology, it allows companies to absorb increases in input costs and not pass those on ultimately to consumers. So if you have a lemonade stand and input costs go up, the price of lemons goes up. If you have one worker that can make 10 pitchers of lemonade and a new machine comes out that can make 100 pitchers of lemonade for similar cost, even if the input prices go up, you don't have to pass those costs on to consumers because you're more productive. The inflation numbers that we've seen recently have been the hottest numbers that we've seen since 1982 for certain sectors of the economy. Now, typically, the Federal Reserve would be very vigilant and respond very quickly to any signs of inflation. They're typically targeting a 2% inflation rate. But recently, they have changed that from a hard line in the sand to promoting an average rate of inflation at 2% over time. That means they can look at the inflation rate over a number of years and allow inflation to kind of accelerate here in the short term to still promote an average of 2% over time. Their main focus right now, because of COVID-19, there's been some slack in the job market. There's been a lot of federal stimulus, which has caused some people to be out of the job market. As that stimulus starts to wane here toward the fall, we're anticipating a large number of people to come back into the job market looking for work. If the Federal Reserve is too preemptive in slowing down the economy, it may start to impact the job market, and these people would not be able to get back to work, which would promote higher unemployment, which the Federal Reserve does not want. And they are actually prioritizing full employment over their 2% long-term inflation mandate. So I anticipate the Federal Reserve really not wanting to put the brakes on the economy too soon, and they want the economy to be able to run and start to accelerate a little bit to promote full employment as we get back to normal after COVID-19. The federal debt was running out of control prior to COVID-19. In response to the pandemic, the federal debt now exceeds $28 trillion. This represents 137% of our GDP, which is even higher than the peak in the 1940s due to increased spending in response to our entering World War II. So we're at all-time highs here. So the amount of money that it costs to service this debt would go up by an order of magnitude if the Federal Reserve increased interest rates dramatically. So I think that alone is going to cause the Federal Reserve to be reluctant to raise interest rates too severely, too dramatically during this particular bout of short-term, potentially longer-term inflation. Final question becomes, if inflation in fact takes hold, how should one adjust their portfolio? So We don't have a crystal ball. So what I did back in November through the beginning of this year was I wanted to increase exposure to investments that should perform well, irrespective of whether inflation is more persistent or if it proves to be more temporary. Now, this shows different asset classes in a low to rising rate inflationary environment and periods where inflation is high and continues to go higher. So, of course, bonds and cash are the absolute worst place to be if we start to see inflation take hold. And that makes sense. So if you have a fixed income coming from bonds, or if you're leaving your money in cash, earning nothing, if inflation takes hold, it starts to deplete your purchasing power. Also, as I mentioned before, interest rates tend to go up in response to long-term inflation to help slow the economy down so that you could kind of stem the impact of inflation. When interest rates go up, the value of bonds goes down. So that's not a place where you want to be during an inflationary environment. Now, stocks in general tend to do well, but specifically emerging market stocks tend to be the best performer in rising interest, in periods of rising inflation. Also, real estate does well because landlords are typically able to pass along increased prices in the form of higher rents. Commodities and gold tend to do well in rising rate environments. What's not shown here are infrastructure investments. These are things like bridges and toll roads and our electrical infrastructure, utilities, things like that. Typically, infrastructure investments represent a monopoly and they're regulated. Regulators by contract allow purveyors of these monopolies to increase their rates when input costs go up and pass those costs along to their consumers. So they're great hedges for inflation. They actually represent one of the best places to be in an inflationary environment. So these are periods of greater than expected inflation. Infrastructure and energy infrastructure are two of the best investments during a rising rate environment. I started increasing exposure to infrastructure again back in November through December and the beginning of January, and those positions have been in place. Also, I mentioned bonds are not such a great place to be during periods of inflation. These are mainly traditional bonds. So I sold off many of those traditional bonds earlier in the year, and I've used something called TIPS. These are bonds that respond in lockstep to increases in inflation. So TIPS are Treasury inflation protected securities. They're a way to maintain bond exposure that moves in lockstep with rising rates of inflation. If you have any questions about inflation or its potential impact on your portfolio, please don't hesitate to reach out. This is Antoine Harris with Platinum Bridge Wealth Strategies. I'll talk to you soon.